Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Banks haven't been in favor since the Great Recession. And while hedge funds and big money managers hold the stocks, they don't hold the same appeal they once did. Instead, we all turned towards high-growth IT companies. But after a decade of seesaw revenues, we think that Citigroup might be primed to really take off. Based out of New York, New York, Citigroup is a globally diversified bank that provides financial services and banking to over 200 million customer accounts in over 160 countries. Generally speaking, Citigroup makes money in two different ways. First, the company makes money on net interest margin. Net interest margin is the difference between the rate the company borrows at and the rate they lend at. Second, banks make money on fees for the services they provide, like loans, wealth management, as well as trading activities. Now, Citigroup's revenues have been lumpy over the last decade. But what is interesting is how its earnings per share grew over the years, along with book value per share. Operating and free cash flow swung around a bit, especially in 2017 due to the tax reform bill, and during the pandemic due to a significant change in trading account assets. And although most investors don't see this, the Tier 1 capital ratio for Citigroup is excellent. This metric grew in importance in the wake of the Great Recession. Tier 1 capital is highly liquid assets that are used to fund bank activities. And looking at valuations, Citigroup's price-to-earnings ratios dominate competitors. Only Goldman Sachs comes close. When we look at the price at price-to-book, it's not even close. Citigroup comes out as the cheapest bank. The price-to-book ratio is important for banks because it compares the market capitalization for a company to the assets on its books. Lower ratios imply a high value. In our view, we rank this stock at 10 out of 10. But how is it that we like such a big bank? Well, for starters, it's the best value amongst the financials. More importantly, we expect banks to do well in the coming years as the Fed raises interest rates. Plus, Citigroup pays a monster 3% dividend. No, we don't think the stock will double over the next year, but we could easily see it driving from $70 to $100 per share. Click and subscribe to the Spill newsletter to get the full breakdown.